Today, we're really pulling back the curtain on Greece's financial landscape. We're moving beyond, those perfect postcard images to get into the practical stuff. This is especially for you if you're thinking about a deeper connection, maybe moving there, investing, or just trying to figure out its unique tax system without getting totally lost. We've got a really fantastic stack of sources here. They cover a lot: income tax, property taxes, and those really interesting special regimes for new residents. Our mission really is to give you a clear picture, a comprehensive one, but without the overwhelm. Help you understand the strategic side of things.
Absolutely. And what's fascinating, I think, is how Greece, while it definitely aligns with EU tax standards, has also quite deliberately carved out some distinct advantages. You really notice these for new tax residents. That's a key point we'll dig into. We'll look at the nuances, like who pays what, why that matters, and crucially, how certain pathways can actually significantly alter your tax obligations. It feels like a system designed to encourage both stability and, new investment.
Okay, so let's start right at the beginning. Who exactly is on the hook for taxes in Greece? Our sources say it's individuals and businesses, but the real key concept here seems to be tax residency.
That's right. For an individual, the main rule is, pretty straightforward. It's mostly about time spent in the country. If you spend more than 183 days in Greece within a single year, you're generally considered a Greek tax resident.
183 days. Okay, just over half the year. But what if someone doesn't quite hit that time frame? Maybe they split time,
Ah, right. Then other factors kick in, things like where your assets are, your citizenship, social security registration, even where your family lives or where your kids go to school. It builds a bigger picture of your ties. And crucially, for foreigners aiming for that 183-day rule, you typically need a formal residence permit. A standard tourist visa usually won't cut it for that long.
Right, so it's not just about being there. You need the proper legal footing.
Okay, for a company, it's considered a Greek tax resident if it's incorporated or established under Greek law. Or, if it's a registered seat, its official address is in Greece. But there's another way. Even if neither of those apply, if the place of its effective management is in Greece, it's also a Greek tax resident.
And the tax year, is it complicated?
No, actually quite simple. The Greek financial year aligns right with the calendar year, January 1st to December 31st. There's just a tiny exception for some legal entities that keep double entry books. Their tax year can end on June 30th. But for almost everyone, individuals especially, it's just the calendar year.
Simple is good. Okay, let's dive into what individuals can expect then. Our sources really stress that individual income tax uses progressive scales. What does that mean in practice?
Right. Progressive means the more you earn, the higher the percentage tax rate applied, but only to portions of that income. It's bracketed. So for income like from employment or business profits, pensions, the scale starts low at 9%. Then it climbs up incrementally. The top rate hits 44%. So for example, income up to 10,000 euros, that's taxed at 9%. But anything over 40,001 euros, that portion falls into the 44% bracket.
Okay, that's for work and business income. What about rental income? Is that handled the same way?
No, it's actually treated differently. Rental income has its own separate progressive scale. That one starts higher at 15% for rental income up to 12,000 euros. Then it jumps to 35% for the next chunk, and it goes up to a maximum of 45% for rental income above 35,001 euros.
Wow. Okay, separate scales. And then on top of all that, there's something called a solidarity contribution. What's that?
Ah, yes, the solidarity contribution. It's basically an additional tax. It gets applied to your total income from all sources, but only once that total goes over 12,000 euros. The rate itself ranges from 0% if you're below 12,000, up to 10% at the very top end for high earners. For instance, someone earning over 220,000 euros would pay 10%.
Right, so it layers on top. Now, these percentages in brackets can get a bit confusing. To make it real, our sources gave a good example. Let's say someone earns 40,000 euros total. Maybe 25,000 from their job and 15,000 from renting out a property. How does the tax actually work out for them?
That's a great way to see it in action. So you'd calculate the tax on the 25,000 employment income using its scale. Then calculate the tax on the 15,000 rental income using its separate higher scale. And then apply the solidarity contribution rate for 40,000 euros total income, which happens to be 6.5% to that full 40,000. When you add all those bits together, the employment tax, the rental tax, the solidarity contribution, their total tax bill comes out to 9,950 euros.
9,950 euros.
Okay.
So that example really shows the complexity, doesn't it? How the different scales and that extra contribution all stack up. You really have to know how each income type is treated.
Exactly. It underscores the need to understand the specifics.
Okay, so that's income. What about property taxes? Not just the tax on rental income, but the taxes involved in actually buying and owning property.
Right. When you first buy, there's the real estate transfer tax, FMA, they call it. It's 3.09% of the property's value, and you pay that up front. Then, every year you own it, there are generally two main taxes. The big one is the annual uniform tax, known as ENFIA. ENFIA is calculated for each specific property. It depends on things like its objective value, that's a government assessment, often lower than market value, its size, location, age, how it's used. It can vary quite a bit.
Okay, ENFIA is the main annual one. The other is the municipal tax, or TTP. This one's much smaller, usually between 0.025% and 0.035% of the property's value.
Yeah.
What's interesting about TPay is that it's often just included in your regular utility bills, like electricity, so it kind of happens automatically.
Oh, that's handy. So how do you actually go about paying these taxes, especially ENFIA? It's become much more streamlined, mostly online now. First, you need to get registered on the Greek tax platform, which is called MyADE. You'll need login credentials. Then, after you buy a property, within 30 days, you have to file a property data statement online. That's Form E9, submitted via MyAAE. The tax authority, the AAD, uses that E9 information to calculate your annual ENFIA. They issue an assessment and usually notify you by email. You can then see your yearly ENFIA notice on MyAE in the debts, payments, and contributions section. It shows the amount, the installment dates, and a special debt identifier code. To pay, you can use that debt identifier code through your online banking, or you can still pay in person at a bank branch if you prefer.
Okay, so the process is get registered on MyAD, file that E9 form after buying, keep an eye on MyAD for the notice, and then pay using the code. Manageable.
Pretty much, yes, once you know the steps.
Right. Now, besides income and property, our sources mentioned a few other taxes individuals might run into. What are the main ones there?
There are a few others. Capital gains, for instance, are generally taxed at a flat rate of 15%. If you're an employee, your share of Social Security contributions is 14.12%, deducted directly from our salary. Then there's withholding tax on investment income. Dividends are taxed at 5%, interest at 15%, royalties at 20%. Though royalties paid to Greek resident corporations are exempt.
Okay. And what about passing wealth on? Inheritance and gifts.
Inheritance tax is progressive. For close relatives, the rates go up to 10%, but for more distant relatives or unrelated heirs, it can climb up to 40%. Gift tax is similar, but there's a really significant exemption for close relatives. Gifts under 800,000 euros between close family members are actually exempt from gift tax.
800,000 euros. That's a huge exemption. That makes a big difference for family wealth transfer.
It certainly does.
Okay, but now we get to something really intriguing. Our sources detail 3 special preferential tax regimes for new residents. These sound like potential game changers.
They really can be. These regimes are definitely a deliberate strategy by the Greek government to attract certain types of people, very targeted. The first one is the regime for foreigners employed in Greece. If you qualify for this, 50%, half of the income you earn in Greece is tax exempt.
50% exempt. For how long?
For up to 7 years.
Wow. Okay, what do you need to do to qualify for that one?
Well, you can't have been a Greek tax resident for 5 out of the last 6 years. You need to transfer your tax residency from a country that has an administrative cooperation agreement with Greece. Most developed countries do. And you need to be either employed by a Greek company or be self-employed or operating your own business in Greece. Plus, you have to declare you intend to stay for at least 2 years.
That sounds like a massive incentive for skilled professionals or entrepreneurs moving there. What's the second regime?
The second is the foreign pensioners regime. This one's aimed, obviously, at retirees moving to Greece. Under this regime, your foreign source income, think pensions from abroad, investment income from outside Greece, is taxed at a very low flat rate, just 7%.
7% flat on all foreign income.
That's right. For a maximum of 15 years. The tax is paid in a single lump sum each year by the last business day of July. Eligibility is similar, not a Greek tax resident for 5 of the last 6 years, moving from a cooperating country.
Still have to report everything, though.
Yes, you still report all your Greek and foreign income, but that 7% rate only applies to the foreign portion.
Very attractive for pensioners.
Okay.
And the third one, the HNWI regime, high net worth individuals.
Yes, the HNWI regime. This is perhaps the most dramatic one. If you qualify, you pay a fixed lump sum tax of 100,000 euros per year. And that flat 100,000 euros covers all of your foreign source income, no matter how much it actually is.
100,000 euros flat, regardless of income level from abroad. That offers incredible certainty.
Exactly. Predictability is key. And there's another major benefit. You are completely exempt from inheritance and gift tax on any assets you hold outside Greece. This regime can also last for up to 15 years.
15 years of that kind of certainty and exemption. What are the requirements? Must be pretty strict.
They are significant. You cannot have been a Greek tax resident for 7 out of the previous 8 years. And crucially, you need to make a substantial investment in Greece. We're talking 500,000 euros. This investment can be in real estate, certain movable assets, shares of Greek companies, or importantly, it can be an investment made under the Greece Golden Visa program.
Ah, so the investment for the Golden Visa could potentially qualify you for the HNWI tax regime as well. A sort of double benefit.
Yes, that's right. They are designed to potentially work together.
And can family join under this HNWI regime?
Yes, relatives can be included. They pay an additional flat tax of 20,000 euros per person per year.
20,000 per relative. Still quite manageable for HNW families. Is there a catch? Does that lump sum cover everything?
Ah, that's the critical caveat. No, if you or your family members under this regime earn income in Greece, that Greek source income is still taxed separately under the normal Greek tax rules. You also can't offset foreign tax paid on that Greek income. The lump sum strictly covers foreign source income only.
Got it. Foreign income covered by the lump sum, Greek income tax normally. That's a vital distinction. These regimes sound potentially amazing. Are there deadlines for applying?
Yes, for all 3 of these preferential regimes, the employee one, the pensioner one, and the HNWI one, the application deadline is March 31st each year. And they aim to process applications relatively quickly, usually within about 60 days.
March 31st deadline, 60-day turnaround. Good to know. Okay, we spent a lot of time on individuals, understandably given those regimes. What about businesses thinking about Greece? What does the corporate tax scene look like?
Right. For businesses, the main corporate income tax rate in Greece is now a flat 22%. It was actually reduced from 24% back in 2021.
So a move to be more competitive.
Exactly. A clear signal. The only main exception is for credit institutions, like banks. They face a higher rate of 29%.
And how are capital gains handled for companies?
Generally, capital gains for businesses are just treated as regular business income. So they're taxed at that same flat 22% rate. Residency works similarly, too. Greek resident companies pay tax on their worldwide profit. Non-Greek resident companies only pay tax on their Greek source profit. And yes, Greece does have controlled foreign company, or CFC, rules to prevent companies from artificially shifting profits out.
Makes sense. Standard international practice. What about VAT? Value-added tax. Is it just a flat rate?
The standard VAT rate is 24%, which is, fairly typical for Europe. But there are significant reduced rates. On certain islands, Leros, Lesbos, Kos, Samos, Chios, the standard rate drops to 17%. And then there are further reduced rates, 13% or 9% on those islands for things like basic food staples, tourist accommodation, restaurants, cafes. There's even a super reduced rate of 6% or 4% on the islands for essentials like medicines, vaccines, books, newspapers, energy supplies, and cultural tickets like theater or cinema.
Wow, quite a few tiers there. Any exemptions?
Yes, key sectors like health, education, culture, social welfare, and some financial and insurance services are effectively zero-rated. And small businesses, those with an annual turnover under 10,000 euros, can actually opt out of the VAT system altogether. They can choose to be exempt.
10,000 euros threshold for exemption. Good for very small operators. Any other specific business taxes to be aware of?
Well, there's a luxury tax on certain goods, 10% on things like jewelry, fur, some leather goods, and 20% on private aircraft, like planes or helicopters, if they're for private use.
Okay. And employer costs. We mentioned employee Social Security. What about the employer side?
Right. The employer's Social Security contribution is currently 22.54% of the employee's gross salary. It's a significant add-on cost.
22.54%, definitely a factor in hiring costs.
Absolutely. And then you have excise taxes. These are quite high on some things. Tobacco is around 35%. Fuel's very high, 63.7%. Interestingly, Greece has one of the highest excise duties on beer in the entire EU. It's about 0.21 euros per standard 330 milliliter bottle.
Ouch for beer drinkers.
But here's the twist. Wine and sparkling wine are completely exempt from excise duty.
No excise tax on wine at all. That's quite unusual. A definite perk for wine lovers moving there.
It is indeed.
Okay, thinking internationally again. Avoiding double taxation is always a big concern for individuals and businesses operating across borders. What's the situation with Greece's tax treaties?
Greece has a pretty extensive network. They've signed double tax treaties, or DTTs, with 57 countries. That includes all the other EU member states, plus major partners like India, China, the US, Canada, UK, many others. Most of these treaties cover taxes on income and on capital, which is the standard way to prevent you being taxed twice on the same earnings or assets. It's also worth noting that a few key agreements specifically with Germany, Italy, Spain, and the United States are broader. They also cover taxes on real estate transactions, inheritances, and gifts.
Good to know those specific countries have wider coverage. So let's circle back to the individual wanting to move. If they want to stay longer than the typical tourist visa allows, say, to hit that 183-day residency threshold or qualify for those regimes, how do they actually get the right permit?
Right, because a standard Schengen visa won't do it for long stays. You need a proper Greek residence permit. Some common ways are, enrolling in a Greek university that gets you a student permit, or securing a job offer from a Greek company leads to an employment permit. Marrying a Greek citizen is another route.
Okay, those are the more traditional paths. What about for wealthier individuals, maybe retirees or investors who aren't planning to study or work in a standard job?
For them, there are two main pathways our sources highlight. First is the residence permit for financially independent persons, often called the FIP visa. For this, you need to prove you have a stable recurring income from outside Greece of at least 2,000 euros per month. You also need to show you have at least 24,000 euros deposited in a Greek bank account. These permits are initially granted for 2 years and are renewable.
2,000 euros a month external income plus 24,000 in the bank.
Okay.
And the other big one, the golden visa.
Yes, the Greece Golden Visa. This one is directly linked to making a significant investment in the Greek economy. The most common route is real estate. The minimum investment there is generally 250,000 euros. That could be buying property or even signing a 10-year lease or timeshare agreement. There are other investment options too, like buying securities or making a large bank deposit, but the minimum threshold for those is higher, currently 500,000 euros.
And this golden visa covers family members too.
Yes, it's quite inclusive. The main investor can bring their spouse, unmarried children under 21, and importantly, the parents of both the investor and their spouse. The residence cards you get are valid for 5 years initially, and they're renewable as long as you maintain the investment.
5 years renewable covers parents too. What are the basic requirements for the investor?
You need to be over 18, have a clean criminal record, and be able to prove that the funds used for the investment were obtained legally. The process itself is relatively efficient. Applications are usually processed within 1 to 2 months. The whole journey, from making the investment to actually getting the residence card in hand, takes about half a year on average.
Half a year start to finish for a 5-year renewable residency for the whole extended family. Seems pretty streamlined. Okay, so once someone has navigated all that and actually secured their Greek residency, what's the absolute first practical tax step they need to take on the ground?
The very first thing, absolutely essential, is getting a taxpayer identification number. In Greece, this is called an AFM number. You need an AFM for almost any financial transaction, opening a bank account, buying property, setting up utilities, and of course, for filing taxes. You get it from the local tax office. You can usually do it in person, or you can grant power of attorney to a lawyer or accountant to do it for you. You'll need basic documents, your ID or passport, and proof of your address in Greece. It's worth noting, if you're a non-Greek tax resident but still need an AFM for some reason, you must appoint an official tax representative who is based in Greece.
Right, AFM first. Essential. And once you have it,
Once you have an AFM number, there's an annual obligation. You must submit the E1 tax return form every year. This applies even if you weren't residing in Greece that year, or even if you earned no income in Greece. If you have an AFM, you file the E1. And if you own property in Greece, you also have to submit the E9 property declaration form annually alongside the E1.
okay, AFM first, then annual E1 filing is mandatory, plus E9 if you own property. Got it. We've covered a huge amount today, from the basic rules to those really eye-catching special regimes and the practical steps like getting an AFM and a residence permit.
We certainly have.
So, stepping back, what's the bigger picture here for you, the listener, thinking about Greece?
Well, I think the big takeaway is that Greece's tax system, yes, it shares features with the wider EU, definitely. But it also clearly offers these very structured, very specific pathways, especially through those special regimes, for new residents and certain businesses to really optimize their tax situation. Understanding the residency rules, the visa options like a FIP or the golden visa, the investment requirements. It's not just about compliance. It's actually crucial for strategic financial planning if you're seriously considering Greece as a place to live, invest, or retire.
Right. It's about seeing the opportunities within the system, not just the rules. Now, a couple of final common questions often pop up when people discuss Greek taxes. First, just bluntly, are taxes in Greece high?
That's always the million-dollar question, isn't it? And it's subjective. If you look at the baseline income tax rates, the VAT rate, they are broadly comparable to many other EU countries, maybe slightly higher in some brackets, slightly lower in others. But, and this is the crucial but, those preferential regimes we talked about, the 50% exemption for workers, the 7% flat tax for pensioners, the 100,000 euro lump sum for HNWIs, they are absolute game changers for those who qualify. They can dramatically lower your effective tax rate, making Greece potentially very, very attractive from a tax perspective if you fit into one of those categories. So it really depends on your specific situation.
So the answer is it depends, but the potential upsides are significant if you qualify for a special regime. Okay, second common question. Is Greece a tax haven?
That one's easier. The answer is a clear no. Greece isn't trying to be an offshore tax haven. It's an EU member. It participates fully in international tax cooperation agreements, information exchange, all of that. What it is doing, as this deep dive shows, is strategically using its tax policy to attract specific types of individuals and capital that it wants to bring into the country. It's competitive, but within the international rules.
So not a haven, but definitely using targeted incentives.
Exactly. And maybe a final thought for you to consider is this. Greece isn't just, ancient ruins and beautiful islands. It's actively positioning itself as a player on the global financial stage. It's deliberately crafting its tax landscape. It really makes you think about how a country's tax policy, these kinds of specific choices, can genuinely shape its economic future and who it attracts, doesn't it?
You are listening to Passport Talks, a podcast on how to become a true cosmopolitan, how to travel the world without visas, create a safe haven for your family, and access top-notch education and healthcare with a second passport or residency.